This is chapter 15. We're going to be talking about data analytics and how it can be used to address accounting questions with data. As you recall, throughout the text, we've talked about the AMPS model, where we start with a question, asking the question, then master the data, perform the analysis, and share the story. And asking the question is really where it all starts, right? So Albert Einstein would say, or did say, if I had an hour to solve a problem, my life depended on it, I would use the first 55 minutes to determine the proper question to ask. And so really isolating and think about what that question would be. There are a lot of questions. And when I think about questions, I think about how they might fall into four types: descriptive, diagnostic, predictive, and prescriptive. Where descriptive says what happened, diagnostic says why did it happen, predictive is predicting or forecasting what will or may happen. And then prescriptive says, hey, how do we optimize? How do we have a forecast of the future? How do we decide what we should do? And so based on that, we can break up our questions for this text between financial and managerial type questions. And so you can see those there and see what those look like. But an example financial question is, what is the balance of inventory on hand? Or why did SG&A decrease compared to the benchmark? Why is revenue up in the West Coast but down in the Midwest would be a managerial type question. In terms of predictive, can we forecast future revenues or earnings with reasonable accuracy? Or what is the chance, can we predict if the company will go bankrupt? Or in managerial accounting, should we extend a loan? Will a prospective borrower be able to repay the loan? What is the forecast of future sales that we should be included in our sales budget or our cash budget? And then finally, prescriptive, will Novartis be more profitable if the FDA approves its new pharmaceutical product? And kind of questions of, hey, should we make a product or outsource it? What level of sales will allow us to break even? Are relevant questions we could ask. And as we ask these questions, we're immediately looking at the analytics that would be needed to address that question. So while we're starting with the question, we're also kind of going back and saying, okay, then this will dictate what needs to happen to address that question. We recognize that data has many characteristics, typically using the 4 V's. So volume, how much are we getting? Is it clickstream data? Is it appear in a print? Is it speech? Is it blogs? What exactly is it? The velocity is a question of how often is it generated? So I often use the example of a stock price is generated at least during market hours every microsecond. But the speed of generation of a financial statement is essentially every quarter, right? At least for publicly traded firms in the 10K. Variety is, how does it come? Is it structured? When I think of structured, I think, can you put it in a table? Can you put it in a spreadsheet? Or is it unstructured? So like a picture or sometimes a blog might be very unstructured. And then everywhere in between would be semi-structured. And then the next one is veracity. I mean, is it, can you trust it? Has it been audited? Is it clean data? Does it have missing data? Does it have facts or does it have opinions? Or, can we trust it? And so that's relevant questions. These data come from a variety of sources in financial and managerial accounting. And financial accounting comes from the general journal, general ledgers, the financial statements, SEC filings, conference calls, press releases, are all relevant sources. There's many more that could be used. I mean, analyst reports, competitor reports, industry reports could all be used. Managerial accounting typically comes from inside the company, but might benchmark on other data, such as budget data, standard cost data, point of sale transaction. For example, Walmart tracks every sale of every item, every SKU, stock keeping unit, at its stores, and has a lot of detailed information that it provides, not only for itself, but for its suppliers. So customer relationship management data, HR data, supply chain data would all be components of managerial accounting to address these types of questions. And so descriptive, again, is what happened. Diagnostic is why did it happen. Predictive is predicting, forecasting. Prescriptive is making a decision to optimize. So we have these definitions here, and each one requires a specific analytics technique that might be used. And we'll provide several of those throughout this chapter as we look forward. But starting with once we perform this analysis, we then want to share the story. And the question is, what kind of visualization makes most sense for the question? For categorical data, you might want to use a bar chart or a horizontal bar chart. For counts, you might want to use a histogram. For multivariate relationships, looking at a correlation, like in this particular lab, you might want to use a scatter plot. And so depending on what the purpose is, will determine the type of chart to use. And they've got both limitations as well. They may not be perfect, but we recognize both the strengths and the limitations. One of the labs we like to demonstrate, and we demonstrate within this chapter, is the ability to predict bankruptcy. So when a company is evaluated for investment or for a loan, whether you give them a loan or not, one of the things you want to do is say, are they going to stay in business? Because if they go bankrupt, you probably won't get paid as much, if anything at all. So Ed Altman, about 50, 55, almost 60 years ago, came up with what's called Altman Z. And we use that in this chapter as an example of analytics, particularly predictive analytics. And he suggested we could use these 5 factors, 5 ratios to help predict bankruptcy. The first one, working capital over total assets. Working capital, if you recall from earlier in the text, is current assets less current liabilities. What we want to know is, will they have cash? If you don't have cash, and you can't get a loan from anybody, you can't sell stock, you're going to go bankrupt. And so the more working capital you have as compared to assets, the better. The next one is a measure of long-term profitability. This X2 here is really looking at retained earnings. That's a measure of long-term profitability. As you recall, retained earnings is the amount of earnings that has not been paid out as dividend since the company began. And so the more profitable you've been in the long term, less likely to go bankrupt in general. How about short-term profitability? So earnings now as compared to total assets. If we're profitable in the short run, probably won't go bankrupt. Okay, how about the market value of the stockholder's equity? Okay, or sometimes we'd call this market cap, and compare that to the book value of the debt. You could think of this as the inverse of a debt to equity ratio. Now, one of the reasons it's reversed is to make all of these, as they are more positive, they're going to go in the same direction, right? The more market value you have as compared to debt, less likely to go bankrupt. And the last one is a measure of asset efficiency, where we're measuring how efficient are we. And we're comparing how much we sell compared to our resources. And all these are measures. So Altman gave this particular formula. And the formula is you multiply each of these factors by a number. Note they're all positive. And we come up with a score. Remember, the higher the score, or the higher each of these individual factors are, the less likely you are to be bankrupt, or the more positive this is, the healthier you are. So you'll note if this Z-score is greater than or equal to 3, you're generally regarded as in the safe zone. You're not currently at risk of bankruptcy. It might not mean you're not ever going to go bankrupt, but it looks good. This is predictive. right? But if you get below a certain number, you're going to be in the distress zone or at significant risk of bankruptcy. And so we do this as a lab, and we can see that lab in here that we do within the text. And so you can kind of see, and so we take 2,965 firms and put them in one of these groupings by firm year. So you can see what that looks like. We also recognize the increasing use of Gen AI. And Gen AI is a Copilot chat, sometimes called a ChatGPT, sometimes called a chatbot, or Copilot that could be used. And we recognize particularly the importance of questions. And so we can ask these questions and we can perform analytics if we know how to lead Gen AI, but only if we really understand the prompts and the way Gen AI works are we able to really harness these generative AI components. And this will be an increasing part of accounting and business and life in general in the future. And so we need to work alongside and use it as a very capable assistant. We recognize these critical thinking skills, and as we think of Gen AI, often Gen AI is able to create things, but if we don't understand the basics of remember, understand, and apply, if we don't understand these things, then if we've created something and have no way to know what it came up with, what value is it? Is really a good question. And so we think about those skills. So as we work with Gen AI, we start thinking about how are we going to use this? So questions, what are some questions that can be answered with data analytics? What are some accounting questions? Notice we can get more specific as we go. So the first one is like, hey, what questions? Okay, what accounting questions? Okay, what if I'm an auditor of a public company? You see how we're getting more specific here and seeing what it looks like? And so we're going to use that to help refine and create prompts that would be useful.